Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Adrian Ash runs the research desk at Bullion Vault. It's the world's largest online investment gold service, and he's online at bullionvault.com. Adrian joins us today from London, England. Adrian, it's good to have you back on This Week in Money.
Hey, Phil, how you doing?
I'm doing fine. European markets positive today. The euro rising for a second straight day against the dollar, all based on hope, of course, that the U.S. can reach a deal to avoid the fiscal cliff. And there's also some good news from Europe today. Italy's borrowing costs hit a 2-year low, and also a deal this week on Greece. All of those things, good news for our friends in Europe.
Well, I mean, it would seem so. I think at the surface level, and certainly the markets are taking it that way. Bottom line is, though, I think it's an odd world we live in, where the receding threat of a US dollar downgrade, is actually good for other risk assets when you consider the long term on this. I think fiscal cliff is a bit of a sideshow in terms of where we're actually headed long term. The same is obviously true for Europe as well. Okay, so Italy's got slightly lower borrowing costs, but if you look, it's already at 120% debt to GDP, which of course is where the IMF and the European Central Bank and the European Union want Greece to get by 2020. I think it's interesting that you have the same flaw there. They can't ask Greece to go below 120. Because that would suggest that Italy is in trouble already. The markets have been looking for good news, I think, for most of this year. I think traders have got really bored of the financial crisis. And I think that's been reflected in what's happened in gold over most of 2012 as well. The narrative of the financial crisis has just become a bit tedious to a lot of people. It's true for a lot of financial journalists, yourself aside, of course, Phil. And people are looking for something else to do now, and they'd quite like things to go higher, and things to start resolving themselves. But I'm afraid that it's just not going to happen.
Adrian, speaking of tedious narratives, here's news from the European Commission, their monthly business and consumer survey. Oh, man. And they're saying economic morale, whatever the hell that is, in the Eurozone improved for the first time in almost a year in November. What does that mean? Is that worthwhile at all?
It's a survey. I mean, it's effectively a survey. There are a couple of respectable surveys in Germany. The IFO survey is big, GfK as well. I mean, these guys, are basically asking a sample of people, what are your expectations going forwards? How are you feeling right now? It's, as with all kind of market research, and that's what this stuff is market research surveys. The questions and the answers are, people can tell you one thing. And they can tell you how they're feeling, but it doesn't really mean that there's a great deal on that. I think in terms of consumer confidence, I think there's more interest coming out of that right now, and obviously people are it's difficult to get more disheartened than people have been in 2012. Difficult to get any, for this to get any worse in terms of consumer sentiment. You look at what's been happening in Spain this year. You look at what's been happening in Greece, of course. I think Italy is finally, people in Italy are coming to realize actually that this problem is coming their way. So you are going to have relief rallies, I think, and that could run for a while. As I say, I think there's a lot of pent-up capital looking to invest, looking to try and make a capital gain sooner rather than later, because people are getting very bored with the idea that this crisis is it's 5 years old now. And people would really rather something else was going on.
I thought this was interesting, the growth outlook from the European Commission. They're saying 0.1% growth in the Eurozone next year. And the OECD folks, they say, nah, maybe not. Maybe more recession continuing next year. What's your feeling on what will happen?
I think when you're looking at those kind of numbers, it's, you're passing this down to such finesse. What's the point? I mean, 0.1% growth, who cares? I mean, it doesn't mean anything. And the more interesting point, really, is what happens to employment. Because take the UK example, for instance. I mean, we're clearly heading for a triple dip now. The economy has been through 2 recessions already since the crisis began. What we haven't had, however, is a very sharp jump in unemployment in the same way as, for instance, the States has, and nowhere near what has happened in a lot of Western Europe. What that means is that businesses, companies have been keeping staff on rather than letting them go. But there haven't been any wage rises, so what you're seeing in the private sector in particular is wage stagnation. And so you're also seeing, thanks to zero interest rates, and I know you want to come on to that and have a talk about central banking in a minute, but thanks to zero interest rates, what you're also getting is an awful lot of zombie companies. I mean, there's a couple of leading insolvency practitioners who are bleating about the fact that people aren't going bankrupt. because they really should be right now. And
it's bad for their business.
Getting a lot of work.
Yeah.
So what you're getting is, I think, particularly in the UK, I've thought for a long time that the UK has been at risk, and I think it might be playing out this way. We're at risk of turning into Japan 20 years ago, where you had a debt-fueled property and consumer credit boom, which then topples over. But rather than there being liquidation, rather than there being things taken, stripped back and laid bare, what you've actually got is, because of monetary policy and because of government policy on this, you end up with a situation where those companies persist, where those jobs, misallocation of resources persists. So you end up with a very overvalued economy, if you like, that continues to trundle along without any growth and without any repurposing of resources.
Adrian Ash from BullionVault.com, our guest here on This Week in Money. And more headlines from Europe today. There's a headline, Adrian, in the Wall Street Journal. BOE warns UK banks to shape up, saying that they're going to have to raise a lot of fresh capital or sell some businesses. What's going on here?
The problem that the Bank of England face, one of the many problems the Bank of England faces, is that the banking sector is so bloated in the UK. It's a phenomenal portion of GDP. If you look at just how big that sector has become over the last 15 years, and it hasn't as yet really started to retrench and shrink back. Financial services have played an enormous part in economic growth over the kind of 1997 through 2007 period, and again, as we were just saying about companies more broadly across the economy, the financial service sector in particular hasn't started to really pull back. So the problem that the bank has in regulating the banking sector, the problem that the Bank of England has, is on the one hand, it is being told politically and it's being told in public, this is what people want in consumer surveys and things. They want the banks to lend more freely. The credit crunch continues. You can't get a mortgage very easily in the UK now unless you've got a very large down payment. Interest rates, unless you've got a very big down payment, actually aren't that low. So, the housing market is just not picking up. On the other side, however, the Bank of England knows that it's got to have these banks recapitalised some more. Difficult to reconcile those two. How do you square that? How do you square them pushing out on the lending curve at the same time as retrenching?
Adrian Ash from BullionVault.com, our guest here on This Week in Money, and a story that's generating a whole lot of press here in Canada and around the world. The next Bank of England governor, right here in Canada, from Canada, the Bank of Canada's Mark Carney, and a great piece in Bullion Vault by Ben Traynor. The Bank of England's new hero. They're calling this guy the best for Britain, Adrian.
Somebody's got to be. I mean, this is the thing, Phil. It's not a job that you'd want, and I guess that's why we're paying the guy so much.
$1 million bucks a year.
He's on like 600,000 sterling.
Yeah.
Is that how much you pay your central bankers in Canada?
No.
I was going to say.
Yeah, he's doing okay.
The analogy which has been doing the rounds here in the media is soccer coaches. And the way that the England football team have in the past have actually roped in foreign coaches because the talent it was deemed that the talent wasn't available domestically. That ended very badly, by the way, for the English football team. So it doesn't bode well if that's the example. But it's very expensive because if you're going to fly in foreign talent, the best foreign talent you can find, then you're going to be paying up for that. And no doubt, as with the foreign football coaches that we've tried, you're going to have some enormous get-out clauses as well. The big golden goodbyes if these guys get the flick or have to move on. I think it's an interesting situation with Mark Carney. Clearly, he has come out of this on a top level, pretty well so far. He's, the Bank of Canada cut interest rates very aggressively through 2008. Alongside everybody else in the G7, but has all since raised them, which is interesting. The Bank of England interest rates are still on the floor. The US Fed interest rates are still on the floor. The ECB looks like, if anything, they're going to go lower. But the Bank of Canada has actually raised rates only a tiny bit, but nonetheless, it's actually made a push in the other direction. And is that having an impact on Canadian inflation? Well, maybe. I saw the latest data is saying that you guys have got 1.2%, 1.3% consumer price inflation year on year. That would be phenomenal if we could have that for real in the UK. We're nearer to 3% and above, and have been for 3 years now. Big difference, of course, in the economy here is that we're not a resource producer. We are, net importers of pretty much everything except financial services. So the pound, the policy has been by the Bank of England under Mervyn King, the current governor. The policy since 2007 has been an aggressive policy of devaluing the pound on the foreign exchanges to try and, improve export growth, try and knock a hole in imports. and try and devalue the debt, which both the nation and the banks in particular have still got outstanding. Has it worked? No, not to date. And of course, the pound has come back up versus the euro in particular because of the Eurozone crisis. So again, central bankers had a great time, particularly during the 1990s and the early part of last decade. Really, I think because the landscape they were operating in was pretty benign for them. I'm not necessarily saying that Mark Carney's had an equally benign landscape in Canada over the last 5 years, but you guys do have an awful lot of natural resources, and that has clearly played in your favor, I think, as opposed to particularly Western Europe, where we are net importers of most natural resources and so on. So going to be an interesting challenge for him, and maybe the salary is commensurate with that challenge.
Yeah, one of the things that Ben Traynor was kind of worried about, and you touched on it earlier when you likened central bankers to football coaches. He's talking about central bankers as superheroes, and that worries him, and that worries a lot of people.
Well, I mean, the cult of central banking has been around for a long time. Particularly since Paul Volcker, I would say, in the States. There was a guy who clearly went out against the political backdrop and did something which was unpopular and clearly was necessary and worked, which was to raise interest rates in the States to double digits, at the start of the 1980s and kill off the inflation that had been built up. In terms of the vaudeville that goes with central banking, obviously Volcker, speak softly and carry a big cigar. Then you had Alan Greenspan, the Wizard of Oz, and his completely impenetrable pronouncements on the way that things worked. We've had a whole list of noble eccentrics at the Bank of England. Mervyn King is a famously kind of bookish-looking academic, but in fact apparently is something of a tyrant within the bank itself. You'd think he'd be a collegial kind of guy with his academic background, but no, apparently it's the court of King Mervyn, so we're given to understand. I think that's maybe why the guy who was his anointed successor, Paul Tucker, his deputy, actually missed out on the job, because he's actually a pretty workaday, boring kind of guy who has spent the last 5 years in particular as deputy building up his contacts within the banking sector, doing the phone calls, talking to the private sector and so on. He's not a high-profile guy, and he doesn't have that big sweep which the politicians who have appointed Carney are perhaps looking for. We need somebody on the world stage. And I see that Mark Carney, Euromoney magazines, he's their central bank governor of the year. It's some kind of title, right? It's almost as exciting as a European Union press release. But, I just find the irony in that it's quite funny, because I remember the Financial Times, for instance, back in 2007, they had their man of the year was Jean-Claude Trichet at the ECB. And we know what a disaster he left behind himself. So, these guys are... It's a very odd thing that we have, I think, in modern democracies. And I think personally it points to the way that modern democracies actually work, which is, of course, elections and so on don't really count for much. Political parties in most parts of the developed world are on the same side of how things are going to work. There's no real kind of radical thinking in terms of opposing the status quo and so on. And what central bankers are there to do is to try and facilitate that as best they can and keep things ticking over. The problems that we have, certainly in the UK, but I would suggest, very similar problems that we have across the developed world in terms of swollen budget deficits, yawning public debts, which at some point, are going to come home to roost. We've seen that in Greece. I think we will see it in Italy sooner rather than later. We'll most certainly see it in Spain in 2013, I think. These are the kind of problems which central bankers can't fix with cheap money. But that won't stop them trying.
Adrian Ash from BullionVault.com, our guest on This Week in Money. Outgoing Bank of England Governor Mervyn King still making news. Today he's saying the bank might have to buy even more government bonds to help Britain's economy get healthy again. So here we go again.
Well, why ever not? They've already bought a third. They already own a third.
Yeah.
And the shenanigans that go on with this are starting to become very obvious. Already, the bank has said, well, the interest which it should be earning on the government debt, on the gilts, it will give back to the Treasury. Okay, so that's 35 billion or so. Okay, fine. Well, we'll just give you that back. So that just vanishes then. One of the contenders for the governor job, thank heavens he didn't get in. He was previously head of the financial services regulator here. He suggested that actually we just write off half of the debt that the bank held. Effectively just monetize the debt, get the bank to, so the quantitative easing just becomes genuinely new money. But this is the thing, the illusion that at some point the quantitative easing will actually be unwound and the governments will have to pay back the central banks. We know this will never happen. This isn't going to be how it pans out in the end. This money will eventually just be given away for free to government, and it'll be monetized. And once we're taking these little baby steps towards that realization, I think, and the closer that we come to that kind of idea, Mervyn King says, let's buy some more. Well, it hasn't done any harm yet. It isn't working, Mervyn, but never mind, it hasn't done any harm yet. We'll do a little bit more. The closer we start tiptoeing towards outright monetization as a headline, bank hands cash to Treasury, then I think the closer we get to the real crisis, which, I do fear is further down the line.
We're talking to Adrian Ash from BullionVault.com here on This Week in Money. And gold rebounding nicely today after that sharp sell-off yesterday. Price falling to nearly $1,700 yesterday. And you have a great piece last week in Bullion Vault giving thanks for gold. And you're saying, hey, we've got a reason to be cheerful about gold, and the future of gold is pretty optimistic.
I think the outlook for gold is, going into 2013, we're at an interesting point now. As I say, I think the story this year for a lot of people who have not been invested in gold has actually been one of, maybe I missed it. Actually, the crisis isn't so bad now. There hasn't been an imminent point of crisis this year in the way that we had in 2011, in the way that we had with Greece in 2010, in the way that we had with the lows in the stock market globally in early 2009. Nothing to match Lehman's, nothing to match Northern Rock the previous year. So you haven't had this kind of clear and present danger that makes people go, geez, you know what I need? I really need to go and get some gold. Yeah. So I think that's why the market has actually held up pretty well through 2012. We know, for instance, that the major source of demand, the world's largest consumer, India, has been knocked back by perhaps 30-40% this year. That's because of various government policies trying to put a block on the import of bullion. It's a big drain on foreign reserves for India. Chinese demand has held pretty steady, which is strong historically from last year, but hasn't raced ahead as it has done over the last few years. I think that's directly related to the slowdown in the Chinese economy. Unlike Western investors in Asia, people tend to buy gold when things are good, when they're growing their incomes, when they're getting more discretionary savings that they can put away. One of the first things that a household that goes from $5 a day to actually having discretionary savings, one of the first things they'll do is buy gold. Sure. So this is a good time investment, and certainly in Indian culture, in Hindu culture, gold is associated only with auspicious investments. It's a happy investment. Whereas in the West, of course, it's always fear and misery that we tend to think of gold about. I think in terms of India, there's some interesting stuff that I heard at the LBMA conference recently in Hong Kong about how there are more auspicious days, about 24% more auspicious days on the Hindu calendar next year than there were this year. And the period during which Hindus won't buy gold because there's no festivities, and it's kind of a lockdown period for the market, that will be cut from 4 to 3 months in 2013. So, there's a lot of professionals on the ground in India who expect a lot more demand to be coming through. China, again, I think is interesting looking at 2013 because we know that under the new leadership, they're going to be looking to make sure the economy is looking strong on the numbers, if not in reality. But I do think that means that infrastructure projects and so on, these guys are going to be pushing for that to keep showing growth. And that, I think, will most likely be reflected in ongoing gold demand. For Western investors, though, I think the key points remain, the ongoing crisis. It's becoming background noise now in a lot of ways. It's just ambient temperature, of crisis. It just continues to tick higher. Just watch out for those sharp spikes in crisis. Obviously, we have fiscal cliff. Then we go into the debt ceiling debate straight away in the United States. I think it's that picks up in February. And then throughout all of this, we have the ongoing threat of what happens in Europe. I think Spain is looking particularly hot right now on that. You've had Catalonia, its most prosperous region. Effectively, the politicians there, they're clearly grandstanding, but these guys are saying, well, we want to secede from Spain. Now, it sounds awfully like the 1930s, and God forbid that we end up in any situation like that. But you can see how monetary politics and how economic problems are really coming to the fore as social issues now in Europe. And I think I do think it's setting a template for what we should expect to see across the Western world.
Adrian Ash, our guest here on This Week in Money. Great piece in the Bullion Vault, the latest edition, different kind of gold investor. Paul Van Eden saying gold is very expensive, so is silver, but he says aluminum, zinc, lead, and nickel are much more reasonably priced. He sees less systemic risk than in gold, silver, or copper. What do you make of that?
I think gold and silver. I mean, silver's a very interesting case at the moment. I mean, there's an awful lot of talk about, silver supplies are very tight. London's got no silver. I don't know where this idea comes from. London liquidity in silver has never been so strong. There's plenty of silver around in London right now. The big data providers, GFMS, they see the silver market in surplus again next year. It's the deficits in terms of supply and demand. Photovoltaic in particular, solar panel demand just hasn't come through strongly enough to really pick up where pre-digital photography used to account for such a huge portion of the market. Even so, though, I think there continues to be a good case for looking at silver and taking a position. In gold, I would agree that there's an awful lot of money in there now with gold. I think we saw that on Wednesday, actually. I think what you saw was some of the hedge fund money turning tail for whatever reason. I don't know whether it was linked maybe to the SAC capital notice that they got from the SEC, possibly. If a big hedge fund is basically hit with redemption notices by its clients because of something which is going on elsewhere, then they're going to liquidate some of their gold positions. That might well then trickle through the market. But with all of that money being in there, it's still, it's a drop in the bucket compared to the value of money which is sitting elsewhere. For private individuals, that would be cash savings. And obviously for the vast bulk of institutional and managed wealth, it's sitting in bonds, whether it's treasury bonds or corporate. Now, debt investments, which both of those are cash on account, is a debt investment because the bank owes you the money.
Sure.
Okay, and I do think that's what's been driving gold and silver higher in the last 5 years in particular, is people typically think gold and silver are all about inflation. That's just not true in the last 5 years. Yes, okay, cost of living has gone higher for most of us. Apparently not in Canada, not so badly at the moment. But what the last 5 years have actually shown us is that people have been concerned enough to go and buy a lump of metal and stick it in a vault or hide it in their top drawer because it isn't exposed to anybody else's default. It's not exposed to some other guy's solvency. It's not going to fail on you if the bank fails. And I think it's that deflationary risk, a very kind of 1930s fear of, in a depression, banks fail and people, debtors vanish and creditors go bankrupt too. I think that's really what's been driving it over the last 5 years. So, I would agree that, there may well be better value opportunities right now short term in perhaps industrial metals, but they are reliant on industrial demand in a way that gold in particular isn't.
Adrian, I mentioned at the top that you were the world's largest online investment gold service, and the last time I checked, you were managing around $2 billion worth of gold. Tell me how Bullion Vault works and how it can help me.
Well, Bullion Vault we're not a dealer, we're an online exchange. So what we actually have is we have pre-delivered vaulted gold and silver bullion. You can choose from New York, London or Zurich for gold, London for silver, although we are very shortly adding Zurich as well, and we are looking right now at other locations in the Far East because we know there's a lot of investor interest out there. And what you do is you buy and sell in free competition with other customers online. We've got 42,000 users worldwide now, and unlike any other business in our market, you can be your own broker, you're your own dealer. There's no middleman quoting you a price, telling you take it or leave it. What you can do on Bullion Vault is you're basically in the market yourself. You can accept somebody else's offer, or you can set your own bid as you choose at no extra cost. We've recently cut our prices to customers. Our initial trading margin has gone down from 0.8% to 0.5%. That's on your first $75,000 or equivalent. Above that, you pay 0.1%. So, we really are the standout offer in terms of cost and pricing to customers. Not only are you getting tight prices between the bid and offer spread, it's a market spread, it's not a dealer spread, you can set the prices you wish in open competition, but you're also getting the very lowest transactional costs. The gold then sits in the vault. You can take possession if you wish. That's going to cost you because it sits in the form of large wholesale bars. That's how we also help to cut costs, is because you're in the large wholesale bar form. This is how the professional market trades internationally. So if you want to take possession, you can certainly do that, but it does cost you a little bit because we've got to fabricate the coins or get the small bars out to you. So that's going to cost a little bit more there. Vast majority of customers are very happy to leave it in the vault where they know it's secure. The vast majority choose overseas. Most of our customers are in Western Europe and the US and Canada, but they typically choose Zurich in Switzerland, which is, I think that's telling perhaps on how people see things developing in the rest of the developed world. Another critical thing that we do feel, I'd say, is very important is, well, how do you know it's in the vault? What we do every single day is we do a public reconciliation of client property with the bar list from the custodian. It's important to have an independent custodian when you're doing vaulted gold or silver, so that obviously we can't mess around with their records. And what we do is we publish on the internet their bar list. So this is from the independent specialist custodian, and against that we then publish all the client records. Your name is anonymized, so nobody knows it's you, but you can find yourself when you're logged out. You can see your holding, you can see that it matches with what you see when you're logged in, and the two totals match down to the last gram. What that means is double counting is impossible. And that, of course, is a big risk when you're in custodial services like that. But as I say, on Bullion Vault, we make that impossible.
Adrian Ash runs the research desk at Bullion Vault, the world's largest online investment gold service, and he's online at bullionvault.com. Adrian, let's check back in a couple of months or so when Mr. Carney's in the job and see how he does.
Absolutely. I look forward to it, Phil.
Hey, thanks, Adrian.
Cheers. You take care.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is editor of Red Hot Global Resources and Global Resource Hunter from Weiss Research. Check out Sean's blog at uncommonwisdomdaily.com. Hey, Sean, it's nice to have you back on This Week in Money.
Oh, thanks for having me on.
You got your latest coming up at Uncommon Wisdom Daily just in time for the holidays. Why silver is heading higher. Now, silver has returned, 23% to date, and December looks even better, Sean.
Well, I think it does. I mean, there's a lot of things that are lining up for silver that just should have a good month. And now, as you and I are talking, silver is falling out of bed, but it's still holding support. So we'll have to see how the day ends. I mean, if it breaks support from earlier, then I might have to rethink things. But right now, at this point, I think that, yes, silver will have a pretty good month, and also it should have a good 2013 as well.
What about some of the technical stuff? The last time we talked, silver was going well. What's it been doing since then? What's it been doing over the last couple of months?
I can't remember the last time we talked, but since early November, it's really been heading higher. It really kind of fell down to its 200-day moving average, which was early November, found support there, and is now back above its 50-day moving average. It has been outperforming, at least until recently, the S&P 500 as well. So it's looking good from a price action perspective. It looks like silver, if it can hold the support that it's testing right now, should go to 35.50 rather quickly, and then the next level above that would be 42.
Okay.
And who knows? Maybe we'll have enough for a run to $50. I don't think we'd see that in this last month of the year, but you know what? Anything's possible. It's just I expect we would see that sometime next year, probably early in the year, because it looks like things are heating up for silver as the global economy starts to improve.
Now, number two silver bell here in your article, China, the China factor. China's economy, of course, improving. That's always good for silver because of the demand, right?
And since I wrote that, there have actually been some things come out that are somewhat negative indicators for China's economy. That's the thing about China's economy, is it's so hard to tell what's actually going on. They report numbers, sometimes they're true, sometimes they're not so true. But as far as we can tell, China's flash purchasing managers index rose and actually expanded in November. It had been contracting, and so it looks like the soft landing is in. Of course, we could get news next week that completely contradicts that. Mm-hmm. But it looks like the soft landing is in China. Now, this is due to the stimulus that the Chinese government is doing, really lubricating the wheels of commerce over there. And they've come up with some make-work projects and stuff like that, the kind of thing you're supposed to do when you're having economic problems, and it seems to be working. So one thing to remember is that silver is an industrial metal. And so if the Chinese economy is starting to get back into higher gear, we'll start to see industrial demand for silver go higher.
Now, what about investment demand? I'm reading today that the Chinese Gold and Silver Exchange Society, they're planning to launch silver spot trading in Hong Kong next year. That's an interesting move.
We'll just have to see how that goes. Certainly, the fund holding of silver is up. I mean, whether you're looking at exchange-traded funds, which recently hit an all-time high, whether you're including things like the COMEX and all the other funds, they are just trucking higher. And also the Sprott Physical Silver Trust, which most Canadians are aware of, that recently raised more money to buy silver, and they were buying a lot, like close to $300 million worth. So there's a lot of fun buying of silver. The mom and pop investors don't seem to be buying it. I'll be buying a few silver coins for Christmas to hand out as gifts, but that's not what they're looking for. They're looking for the mom and pop investors to really stock up on silver coins. We probably won't see that again unless and until we see some real inflation, or at least fears of inflation.
Okay.
Because that's the kind of thing that stokes the mom-and-pop investors. That's why they buy silver. However, it is interesting that the big funds are buying it, and so they have their reasons, probably because they believe that one of the things that is going away in the fiscal cliff negotiation in the U.S. will be the debt ceiling. And so it'll be easier for the U.S. government to add on debt, and that is inflationary. So we'll probably see that. Also, in other parts of the world, we're also seeing more buying as well.
We're talking to Sean Brodrick from UncommonWisdomDaily.com here on This Week in Money. And, of course, one thing we always have to consider when we're talking about silver, this is Silver Bell number 5, the U.S. dollar. What's it been doing, and then how does that affect silver?
Well, what I put on the UncommonWisdomDaily.com piece that I wrote was a longer-term chart of silver, a weekly chart of silver, going back past the beginning of the year. And looking at that, it sure looks like we're seeing a head and shoulders pattern trace out in the U.S. dollar index. Now, that has to be completed. We need to see the neckline broken. There might not be a head and shoulders neckline, head and shoulders pattern, but it looks like we're seeing one put in. That plus we are seeing momentum diverge with price. These are things that kind of tell us that the next big leg down in the U.S. dollar could be down. The next big leg in the U.S. dollar could be down. And so, that could bring it down to, 75, 74,
okay,
that kind of thing. And so if that happens, because precious metals, gold and silver, are priced in dollars, that would tend to push the price of silver higher. And so that's one of the things we are watching now today. As you and I talk, we are seeing the U.S. dollar struggle at its 50-day moving average. If it loses its grip on that, then we could see this head and shoulders pattern, trace out rather quickly, and so maybe by the end of the year even. I mean, that would be rather quick to see that kind of thing take place. I'd expect something more in the first quarter, but you never know. Sometimes these things can move faster than you think. And, of course, there is always the potential that isn't going to happen. Maybe it's not quite what the chart is telling us at this point. Maybe the U.S. dollar will go higher. A lot depends on the fiscal cliff, frankly, because people are just unsure how much spending is actually going to be undertaken when all the fiscal cliff stuff is actually hammered out. And so that puts some real uncertainty into the stock market, into the dollar, into all sorts of things. So we need to see that worked out before I think many people will really commit one way or the other in this market. And so I think a lot of people are going to be sitting on their hands going into the holidays, which might be a shame because I think you might be missing out on the potential for a Santa Claus rally. But I can certainly understand why anyone would do that because of the uncertainty.
Money printing all over the world, and we've got to think about the Fed factor. December Fed meeting coming up. They're talking about QE4. That hopefully will be good for silver, will it not?
Yeah, well, that's the funny thing. There are some members of the Fed who are quite hawkish, and so they come out and say, we aren't going to print anymore, and then the market, says, oh my gosh, and everybody runs for cover. And then other members of the Fed come out and say, we need to print until we get to 6.5% unemployment. And then the market says, oh, really? And then it comes out from under the bed and starts running around having a party again. So it is funny because, the Fed has a split personality because the people on the Fed have differing views, and that's one thing I think that's just driving people crazy. However, the overarching vision is set by Ben Bernanke, and he is dovish. He wants to keep printing until we see some real pickup in the economy and stuff. One thing to keep in mind is that the inflation rate has fallen below the Fed's target, which is 2%. It's now at about 1.6%. That is a key indicator that the Fed is not only going to keep printing at the rate it is, but it's probably going to print even more. Mm-hmm. So you put those things together, probably going to see more Fed printing, probably going to see another program announced either at next Fed meeting, or they'll give hints about what they're going to do in the new year, which is more likely because they like to ease into everything. So when we hear that, that could really perk things up. So you have to balance that, which is a bullish force, against the fact that the Republicans and the Democrats seem at loggerheads, and President Obama rolled out his plan, and then Mitch McConnell on the Republican side came on and said, "Oh, that's laughable, ha ha ha," and so ha ha ha, as in not as funny, it's ha ha ha, this thing isn't going anywhere. So they do have a problem there, and so that kind of uncertainty about the fiscal cliff could push down on the market, while at the same time there are other forces pushing it up. So we could see some real zigzags here.
Okay.
And my strategy will be to buy the dips because I do think they are going to work something out. It might be 11th hour. It might not be until the end of the year, or else maybe early in the part of next year if they really decide to push it. But I do believe they will have a deal eventually, and so that will be good for things overall.
Sean Brodrick from UncommonWisdomDaily.com, our guest here on This Week in Money. We're talking about silver. Sean, we've talked about industrial and investment demand for silver. What about the supply factor here? Just reading the total annual silver supply recently exceeding 1 billion ounces for the first time ever. How significant is that?
Well, that is pretty significant, and sure, as demand for metals of all types goes up, and it seems like we are starting to see a bottom in zinc and lead prices finally. So as those metals get more, as those metals get mined more, silver is usually a byproduct of those metals. And so that brings more supply onto it, and so that could weigh on prices. That said, if we do see a general economic recovery along with all the money printing we have, that tends to be inflationary, so then we can see the mom-and-pop investor come back in. So there are many forces at work in this market. All I can say is the general trend looks good. And so I think that's a trend we should be playing right now.
Interesting stat here from the GFMS folks, Sean. 6 of the world's top 10 largest silver producers are actually not primary silver companies. That's a surprise to me.
Yeah, so it's really the base metal producers. Okay. One more thing to keep in mind is we are starting to see more resource nationalism. That is, countries or sometimes local governments coming in and saying, you guys don't know how to run a mine. You've really made a mess of this. We have our own ideas. And so that can weigh on supply. It hasn't weighed on it much yet, but we have seen at least a couple mines shut down because of problems with the locals. And so if that turns into a trend for 2013, that would send prices higher too. I certainly hope that's not one of the trends we have. While I do like silver and I would like it to go higher, that's not one of the reasons I would like it to go higher. But just one thing to keep in mind is things have been pretty quiet on the political front recently, even despite the fact that there are temperatures simmering underneath. It's seems like there's some stuff that might happen in some of these more far-flung places where silver is produced. So if you are buying a stock of a silver miner, one thing to keep in mind is the geopolitical situation where it is. And with that said, places like Canada, with the exception of maybe Quebec, and the U.S., especially places like Nevada and such, are great places to pick up a silver miner simply because of the good geopolitical climate.
Speaking of mining stocks, let's talk about them for a second and about ETFs as well. Are there opportunities out there for investors looking for bargains?
Well, I think so, but what do I know? I mean, yeah.
Good point.
Because many of these things have been beaten down so much. I mean, not to speak about anything particularly, but just to look at the SIL, which is the Global X Silver Miners ETF. Now, we have a small position in it. It's up slightly. It's nothing to write home about. But I think it's going much higher, simply because silver miners have been beaten down, and also silver has underperformed silver. Silver miners have underperformed silver. So, therefore, if silver starts to go higher and we start to see some of that pass through, we really could see some outperformance in the miners compared to the metal. And so I think that that's one way people could play it. But again, you can have something happen where the locals come over and kick out the company running the mine and stuff like that. So with the individual stocks, be very careful. and just be sure that you buy ones that are in very good jurisdictions. And then you have the ones which I've liked in the past, which are perennially undervalued, like Impact Silver, for example. It's in a great mining jurisdiction in Mexico. It has lead and zinc, which is one reason it's been beaten down for so long, but the prices of those are starting to improve, so that should help this company. And it keeps opening up, one mine after another in its area. So I think that things will work out for it, but they aren't working out right now, so that's one thing that many of us in the industry are dealing with, is we see things that are incredibly undervalued, and it's kind of a bitter pill to sit and watch them sit there for a while when we think they could do much better. So, if you have the stomach for it, I think it's a good time to buy.
Okay.
You just have to be prepared for that volatility because it could be something else.
Sean Brodrick from UncommonWisdomDaily.com, our guest here on This Week in Money. Something you touched on earlier. What about the coin market? What's happening with gold and silver coins?
Oh, terrible. I mean, just really off, and so I think that there's a lot of room for improvement there as well. Again, as I said, it really depends on people's fears of inflation. No one's worried about inflation right now, despite what you hear from some of the scaremeisters. No one really is. But if you see inflation start to pick up, then you could see mom-and-pop investors start to come back and buy gold and silver coins, especially silver coins because they're so cheap. So look for that. We'll have to see how things go. But again, I'm starting to feel more positive on the economy generally.
Okay.
Not like I'm doing handstands. It seems to be a slow recovery, but it seems like it's slowly improving. That's good. And if we have all the Fed money pumping, which we do, if we have all the money pumping from all the central banks, Japan's really getting into that party, for example, and if we start to see the global economy start to improve, and there are some hints from China and places like that, that's exactly what we're seeing, then we should see inflation start to pick up again. If inflation picks up, mom-and-pop investors will start buying those coins again, and then the coins will take off.
Okay, bottom line for silver, if it pushes over 35.5, let's look for 42, and maybe, if we're lucky, we could get up to 50, which was last year's high, right?
I wouldn't expect it to stay there, not on the first try, but it would be a sweet ride if it does. Again, I don't expect that until next year, but a run at 50 in the first quarter wouldn't surprise me. And, if it didn't happen, I wouldn't be too disappointed either. As long as the general trend stays higher, I'm fine. And I think people have to accept that. There are good ways to play this market. You can do it with the miners. You can do it with the metals. But it looks like the time's coming around for precious metals to start to heat up again, and if that's the case, we could see some real excitement here.
Excellent. Sean Brodrick, editor of Red Hot Global Resources and Global Resource Hunter. Check out Sean's blog at uncommonwisdomdaily.com. And you can also find Sean on Twitter, just like 1,600 folks and more have, at Sean Brodrick. Hey, Sean, it's always good to talk to you, man. Thanks.
It's always good to speak to you. And one thing I would like to add is that one thing people might look at is Canadian energy companies. We didn't have a chance to speak about it this time. Okay. Maybe next time we can. But the insider buying in Canadian energy companies is picking up rather remarkably. And so that's kind of a sign that a sector that has been underperforming for a long time. Gosh, if you think things are bad in precious metals, you should speak to one of the guys in the energy sector right now. But an area that has been underperforming for a long time may really be poised on just a big comeback. So keep your eye on that. Maybe we can speak about that next time.
Hey, good tip. We'll follow up on that.
Thanks.
Thanks to our guests, Adrian Ash and Sean Brodrick. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.